Picture this: the near future. You go to buy an electric vehicle, a smartphone, or a solar panel, and the dealership tells you production has been halted globally. The raw materials exist, but the single country that controls 90% of the processing refuses to export them. By the end of this video, you will understand the quiet, multi-decade strategy that cornered the periodic table, and how this choke point dictates the next global wealth transfer. At first, the public will call it a shortage. That word sounds temporary, manageable. A shipping issue, a delay. It is not a shortage. The ore is still in the ground. The deposits still exist. The demand forecasts still look triumphant on PowerPoint slides in Brussels, Washington, and Wall Street, but none of that matters if the material cannot be separated, refined, magnetized, alloyed, and turned into something a factory can actually use. That is the break modern societies still do not understand. A nation can have capital, patents, engineers, military budgets, and climate targets. It can announce industrial renewal, subsidize domestic factories, and promise strategic independence. But if the refining stage sits elsewhere, then the sovereignty was always theatrical. The factory was never truly domestic. It was simply the last visible stop in a chain controlled by someone else. And when that chain tightens, the effects do not arrive first in diplomatic communiques. They arrive in smaller ways. Production delays, defense procurement overruns, idle lines, component rationing, a contractor told to wait, a battery plant missing a shipment, a manufacturer discovering that global supply was really one narrow gate with one political owner. The next resource war will not be fought over who has the rocks. It will be fought over who can process them. For most of the 20th century, the strategic resource story was told through oil. Whoever controlled extraction, shipping lanes, and refining capacity could bend entire nations around an energy map. That framework is now incomplete. The new strategic resource war operates one layer deeper. It is not centered on the wellhead. It is centered on the processing stage that sits between geology and industry. That is where industrial dependence becomes political leverage. This matters because modern states are trying to electrify transport, digitize infrastructure, expand weapons production, scale grid storage, and build renewable systems all at once. On paper, these look like separate sectors. In reality, they converge on the same upstream material system. Rare earths, lithium, cobalt, graphite, nickel, gallium, germanium, tungsten, antimony, and a wider class of critical minerals that most citizens will never see but use every day. What gives these materials strategic value is not rarity alone. In some cases, the problem is not whether the world has enough ore. The problem is whether the world has enough refining, chemical conversion, metallurgical processing, and component manufacturing outside a narrow geographic concentration. That distinction changes everything. A deposit in Australia, Canada, Brazil, or Africa does not automatically become strategic independence for the country that mines it. Raw concentrate is not a finished capability. A nation can dig material out of the earth and still remain dependent if the crucial intermediate stages happen overseas. In that case, it is not selling sovereignty. It is exporting it in raw form and buying it back at a premium. That is the quiet architecture of the current system. The West largely organized itself around high margin layers: design, branding, software, final assembly, capital markets, defense contracting, and consumer ecosystems. Those sectors looked dominant because they were visible, profitable, and politically flattering. Meanwhile, the dirtier, lower margin, chemically complex steps were pushed outward. Refining was treated as an environmental inconvenience. Separation capacity was treated as a commodity service. Processing was assumed to be replaceable. It was not replaceable. It was strategic. That is the promise of this story. We are not looking at a passing trade dispute or another fashionable commodity cycle. We are looking at a structural transfer of leverage from the owners of consumer demand to the owners of industrial bottlenecks. And once you see the system clearly, the investment implication becomes difficult to ignore. The money is not necessarily where the public excitement is. The money sits where production can be stopped. The processing empire was not built overnight. It was assembled patiently, in layers, while the West mistook industrial complexity for an inconvenience and strategic dependence for efficiency. In the 1980s and 1990s, Western economies were still operating under the old assumption that resource security meant access to deposits, shipping, and capital. If the ore could be bought somewhere, the rest would sort itself out. That belief came from an era when supply chains were shorter. National industrial policy still had memory, and the geopolitical environment seemed to reward cost minimization above all else. China approached the same landscape differently. It understood that the dirtiest segment of advanced manufacturing was often the most decisive. Rare earth separation is chemically difficult, environmentally costly, and politically unattractive in liberal democracies. It produces waste. It requires tolerance for low margins in the early years. It demands scale before it produces strategic power. In most Western boardrooms, that looked like a poor business. In state terms, it was a nation-building asset. So while the West celebrated the visible summit of the value chain, consumer electronics, software, semiconductor design, branded hardware, green technology deployment, China moved underneath it. It expanded control over mining, yes, but more importantly, over midstream capacity, refining, solvent extraction, separation technologies, metallurgical processing, magnet production, precursor chemicals, and the industrial ecosystems that allow these steps to reinforce one another. That distinction matters because a mine on its own is vulnerable. Ore can be stranded. Concentrates can pile up. Deposits can remain geologically impressive and economically useless. But when one country becomes the place where raw material is transformed into industrial input, the mine begins to orbit the processor, not the other way around. This is where the Western era becomes forensic. The West assumed supply chains would remain permanently global, permanently open, and permanently governed by price. China appears to have treated supply chains as future instruments of state power. One side outsourced an unpleasant industry, the other absorbed it, subsidized it, learned it, scaled it, and waited until the dependency was too embedded to unwind quickly. That is how empires are built in the modern age. Not always with fleets and flags, but with licensing systems, industrial chemistry, logistics corridors, and tolerated losses that private competitors cannot justify quarter to quarter. And the public missed it because the dependency did not feel dangerous at first. Stores were full. Devices got cheaper. Solar panels scaled. Electric vehicles multiplied. The visible economy was thriving. That underneath that abundance was a silent transfer of leverage. The West kept many of the logos. China accumulated many of the gates. That difference only becomes obvious when the system is stressed. A defense manufacturer does not care that ore exists somewhere in theory if the separated material cannot be delivered on schedule. A battery producer does not care that a friendly country has reserves if conversion capacity sits offshore. A government cannot claim industrial resilience when a permit in one jurisdiction, a license in another, and a single processing bottleneck can freeze production across multiple sectors at once. This was never just about mining. It was about deciding who gets to turn matter into power. And that is why the old empires of extraction are less relevant than the new empires of transformation. There is an older warning buried in imperial history. Spain possessed one of the greatest resource windfalls the world had ever seen. Silver flooded out of the Americas in astonishing quantities. On paper, that should have guaranteed durable supremacy. Treasure fleets arrived heavy with metal. The crown had access to what looked like inexhaustible wealth, and yet the empire repeatedly drifted into weakness, dependency, inflation, and financial strain. Why? Because owning the raw resource was not the same thing as controlling the system that gave it durable value. Spain had silver, but much of the broader commercial manufacturing and financial machinery sat elsewhere. The metal could be extracted, transported, taxed, and spent, but extraction alone did not guarantee productive dominance. Possession created the illusion of strength. Processing, industry, distribution, and financial control determined who actually converted that strength into lasting power. That pattern matters now because modern policymakers still confuse reserves with sovereignty. They announce domestic mineral discoveries as if geology itself solves the problem. They speak as though access to ore automatically means security. But a buried deposit is only potential. A truckload of concentrate is only partial leverage. The decisive question is what happens next. Who separates it? Who refines it? Who converts it into magnets, battery-grade chemicals, alloys, wafers, powders, components? Who controls the technical standards, the permits, the waste tolerance, the logistics, the timing? That is where the Spanish warning becomes modern. A country can sit on strategic minerals and still function like a colonial appendage if it exports the low-value material and re-imports the high-value industrial result. In that arrangement, the resource-rich nation plays the role of extraction zone while another country captures the strategic margin, the industrial learning, and the coercive power. This is why the phrase resource-rich can be deeply misleading. The world is full of places with deposits. It is far less full of places with commercially scaled, politically protected, environmentally tolerated processing ecosystems. Those ecosystems are harder to build, easier to weaponize, and slower to replace than most investors understand. Spain's silver bought splendor, wars, and temporary prestige. It did not guarantee control over the system, and in the strategic resource war now unfolding, that same mistake is being made again by countries that still think owning the rock is enough. This is the point where most investors get trapped. They begin at the visible end of the chain. Electric vehicles, robotics, data centers, solar manufacturers, defense primes, chip makers, battery brands. They look for the next explosive demand curve, then assume the winners will be the companies selling the final product into that excitement. Sometimes that works in the early phase, but in a chokepoint system, downstream demand can become a distraction. When processing capacity is narrow, the glamorous end-user business often carries the political risk, margin compression, and supply uncertainty, while the upstream bottleneck captures the real strategic value. That is the inversion people miss. If 10 manufacturers are competing to sell advanced products into a high-growth market, but only a handful of firms control the refining, chemical conversion, metallurgical treatment, or specialized intermediate inputs that all 10 require, then the apparent innovation race may actually be downstream theater built on upstream dependency. The first question is not which product will dominate. It is, which stage can halt everyone else? That is the foundation of the supply chain vulnerability checklist. Start with a simple discipline. Never analyze a company from its branding outward. Analyze it from its material dependency inward. What inputs are truly non-substitutable at commercial scale? Which ones require specialized separation or refining? How concentrated is that capacity geographically? Is there spare capacity in allied jurisdictions or only theoretical reserves? What environmental, permitting, labor, waste, energy, and water constraints block rapid expansion? How long would it actually take to replace the missing stage, not in press releases, but in operating industrial time? Then move to the political layer. Could export controls, licensing rules, sanctions, customs delays, or informal state pressure interrupt access even without a formal embargo? Would the choke point appear first in defense procurement, consumer electronics, grid infrastructure, or automotive production? Which customers get rationed first when supply tightens? Who has bargaining power? And who has only forecasts? Then the balance sheet layer. Does the company you are analyzing control any part of the bottleneck itself? Or is it merely exposed to it? Can it pass through higher input costs? Does it have long-term offtake agreements, vertical integration, stockpiles, substitute chemistries, or friendly jurisdiction processing partnerships? Or is its entire valuation built on uninterrupted access to a material system it does not control? This is where the investment angle becomes more sober and more useful. Do not confuse demand certainty with supply security. Do not confuse reserves with throughput. Do not confuse a factory opening with strategic independence. In the choke point age, the most valuable asset is often not the brand the public desires. It is the bottleneck the public never sees. So the illusion to discard is simple. Western manufacturing independence was never as complete as it appeared. A country can assemble sophisticated products, publish industrial strategies, subsidize domestic plants, and still remain dangerously dependent if the decisive material transformations occur elsewhere. In that world, prosperity is conditional. Rearmament is conditional. Energy transition is conditional. Energy transition is conditional. Even technological ambition is conditional. The forensic record gives us a cleaner rule. When a system is under stress, what survives is not what is most celebrated. It is what is hardest to interrupt. That is the practical conclusion of this entire resource war. The investor, policymaker, or business operator who studies only the final product is studying the least important layer. The real question is always the same. Where does the chain narrow? And who owns that narrowing point? Because that is where price power lives. That is where coercion lives. That is where delay becomes policy, and policy becomes profit. There are caveats. Choke points do not last forever. High prices invite substitution. Governments can overreact. New processing corridors can be built. Technologies can change chemistry. Political coalitions can absorb short-term pain to regain long-term autonomy. No bottleneck is eternal, but history is not kind to societies that notice strategic dependence only after the embargo, the licensing order, or the production freeze. By then, the investment has already been made. The vulnerability has already been priced incorrectly, and the public is still arguing about shortages when the real event is loss of control. So here is the binary choice. You can keep analyzing the modern economy from the showroom, the product launch, and the headline demand story, or you can analyze it from the refinery, the separator, the export license, and the gate that can shut the entire system down. One of those perspectives sees growth. The other sees power.